Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Investment advisory services offered through Pure Portfolios, a registered investment advisor with the U.S. Securities and Exchange Commission. Nick Shermans and Aaron Varghese work for Pure Portfolios. Any opinions expressed by Nick and Aaron or any podcast guest are solely their own opinions and do not reflect the opinions of Pure Portfolios. This podcast is for informational purposes only and should not be relied upon for investment decisions. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax professional. Clients of Pure Portfolios may maintain positions in securities discussed in this podcast. This information is not an offer or solicitation to buy or sell securities. The information contained may have been compiled from third-party sources and is believed to be reliable. Hello everyone, and welcome back to another episode of Blind Spots. I know we've got a little bit of a weird title today, but if you have listened to Blind Spots before, you might have heard this quote from our friend Warren Buffett. He says that only when the tide goes out do you discover who has been swimming naked. So we've had similar conversations and questions from different clients and prospective clients who are all experiencing pain this year. And we saw a glimpse of this back in 2020, but the recovery covered up a lot of the pitfalls that we are starting to see clients experience again. So this podcast episode is for you if you are agonizing over what happens next, if you are feeling out of control of your finances, and if you need a little bit of guidance to get back on track.
So that's a good open. I'll set the table a little further. So the last 10 years, we've seen low interest rates. Inflation has been hovering around the Fed's 2% target. Markets have been up. I've called it a golden decade in my blog, where investors could basically throw a dart and land on a stock or a fund or a ticker symbol, and they've been able to make money. That environment became their new baseline. It became people's new baseline. And humans tend to extrapolate what just happened. And it's like Excel, when you click the bottom right corner and just drag it to the right, you're basically extrapolating the current trend well into the future. That's what investors have done. They built their lifestyle around the premise that markets always go up. Well, 2022 has been a total 180. Inflation is higher. Rates are going up. Most every asset class is down. And what we're seeing is people barreling forward like nothing is wrong. They're like, they might worry to their friends or to their advisor or in their social circles about what's happening, but their behaviors, their actions are the exact same. So what we're going to be doing today is outlining several of these behaviors, these pitfalls that taken in isolation aren't a big deal, but when you stack them up and you just barrel forward like nothing is wrong, they can derail even the most well-intentioned person.
Yep. So we're just going to be talking again through some of these pitfalls and behaviors that we see clients falling into. So I think it will be good. I think this will resonate with a lot of people. And I think this is a good one for people to hear.
So the first one is building a lifestyle around markets only going up. So you might say, well, what the heck does that mean? Well, it means, let's say you've got $1 million and markets are going up by 10% a year. That's a rough gain of $100,000 a year. Okay. If your target spend is $60,000 a year, you could easily spend 80 or 100,000 in those years that markets go up, and your portfolio value, the principal value, does not change. That can embolden someone and reset their baseline to think that level of spending, an 8% withdrawal rate, a 10% withdrawal rate, it's not a sustainable normal. And what we're seeing today, and I wrote a blog about this a couple weeks ago, and I say that a lot, I'm sorry, but it's true, where we're seeing people model the $60,000 spending level, and I'm just using that, I'm just throwing that out there, but their actual spend is 100,000 or 120,000. So when we're modeling the plan, it's all good, but when we look at what they're actually taking out, it's double what we're modeling, which obviously is not sustainable. Obviously, the financial plan is going to be misleading and giving them a false sense of security if the numbers are incorrect. So we've been going back to the drawing board with many clients to look at what they're actually spending versus what they're modeling. And oftentimes there's a pretty large disconnect.
Yeah, and when building a financial plan, we always say if you put crap in, you get crap out. And that's a trend that we've started to see as we revisit financial plans and make updates, as we always do when we meet with clients. And we often ask the question, how much are you spending? Is this still pretty consistent? And people usually don't have a good idea of exactly what they're spending, and that's fine. But when there is, and we use this word disconnect, and maybe that's not always the best term, but if you don't have an accurate read on what is actually coming out of your bank account every single month, you are going to have a disconnect between what we're saying is happening and what is reality. And that's where the problem lies.
Well, and we're not saying you can't take a vacation or you can't live a normal lifestyle. We're just saying have a pulse on your spending, right?
Mhm.
Like a lot of people worry about these external factors, about what the Fed is doing, about what Russia's doing, about what China's doing, inflation. It's perfectly okay to downshift your spending during a difficult market environment. And it's not dissimilar to what you probably did in your career, right? Like I was telling Aaron back in the 90s when my dad would come home from work, he would say, "Oh, they're cutting jobs in my department. It's time for us to trim our monthly spending." That's completely normal. It's the same concept. You don't just barrel forward like the markets perpetually go up by 10% a year. You reassess, you make sure your inputs and what we're planning for is correct, and you make adjustments.
I'm sure that people still do that, but do you feel like you've seen a shift in the last 20 or I don't know, 30 years of that changing, where that, maybe you do see cuts in your department, but we're still not going to make a change because everything is still going to be okay?
I think the working man or woman or family can perhaps take that attitude. I mean, it depends on what type of employment you have. If you're a
Mhm.
real estate agent or a mortgage broker, that line of thinking would probably not end well. But if you work for the government and it's impossible to get fired and you're rep by a union and you have a pension, you probably can get away with that. So like anything, it depends. But I think for a retiree who's living off a fixed income or living off their portfolio, it's always better to err on the side of things hitting the fan and then adjusting from there. Don't assume the base case is rosy and you're going to get 8% per year and it's going to be a smooth ride. Assume future returns are going to be lower. Assume inflation is going to be higher. Assume your portfolio goes down by 30% next year. That's a better baseline to work off of than the one of delusion.
Yeah, this is the last comment I'll make on this topic so we don't drown on too long about it. But when we are building financial plans, you're talking to your advisor about what you spend or future plans, and we have to build in our own assumptions. We always, like you said, err on the side of caution with things like your rate of return assumptions, because if you put on these rose-colored glasses and you say, I'm going to make 10% a year, of course your plan's probably going to work. But that's why when we model out spending, we try to be more aggressive on the expenses and then more conservative on, again, things like rate of return.
Okay, Aaron, what's the next leak?
The next one that we have been seeing a lot is kind of piggybacks on the last one of your actions not lining up with your beliefs. Saying that life is doom and gloom, markets are going to zero, the world's going to end, but you're doing all of these things that say exactly the opposite, like leasing an expensive car or buying a second home or leveraging yourself out by borrowing off your portfolio. So we see a lot of people saying one thing but doing another.
Yeah, and a big one that I think is understated and probably a subtle risk to many people's retirement plans is helping out their adult kids, gifting money to their kids. And look, I'm a father of three. I know the role my kids play in my life, and if they were down on their luck or if they needed assistance, I'm not going to say that I won't help them, but I think there's a balance between sacrificing your own plan and helping your kids. And what we often see is promises made. I'm going to give you 50 grand to help you buy a new house in 2025. Well, a lot can happen, as we've seen, a lot can happen in a couple years. And I think when people anchor to those things and say, I'm going to give 50 grand to my daughter come hell or high water, that inflexibility can put your own plan in peril. So Aaron's got an analogy. Aaron, you want to share the oxygen analogy, which I don't even know what it means, but maybe you can connect the dots.
Yes, when I heard this, I thought that it was pretty close to genius. But when I've said it to clients, it's like the light bulb goes off, the puzzle pieces click. So we refer to this as oxygen mask finances. And that is just classic, you're on an airplane, you're going through your exit strategy and, all the things to do in case of an emergency. That when the oxygen mask comes down, you have to help yourself before helping others. And that includes your kids, your grandma, whoever. So make sure that you're taking care of yourself before helping others. Because if the oxygen runs out, you're out of luck.
Then you're taking a dirt nap and no one is better off.
Yeah. So there's good gifting strategies. This can help with estate planning, but always make sure that you are in line first.
Well, in a way to see, a tangible way to see if you're in line is model the gifting to your kids or your heirs or whatever. Model that in the financial plan and run it out. And if your plan is on the verge of running out of money at the end of it, so the end of 20, 30 years, if you're at the risk of running out of money, maybe you dial that back. Maybe you say, this is something I'd like to do, but we're not going to include it in my core plan. Aaron, what's the next one?
Oh, this is a fun one. People anchoring to things that just don't apply to them. And we see this in a few different ways, but a big one is Roth conversions. That's kind of the popular obsession, is thinking that you need to do a Roth conversion because you've seen it on VC, you've read articles about it, your friends are doing it. And we've talked about Roth conversions before, but it's one that always sounds really good in theory, but doesn't always work out in someone's favor.
Right. And if you haven't seen the podcast and the blog post about Roth conversions, we encourage you to check that out. Our message is to run it in the context of your plan. Just because your friend did it, just because everyone's doing it, just because famous people do it, doesn't mean a Roth conversion is right for you. It's not a decision that's made in a silo. It's a decision made in the context of everything else that you have going on.
Yeah. And we talked about this a lot in our taxes and retirement plan episode as well, that just like you said, not making the decision in a silo, doing these Roth conversions can have big impacts on your income, your taxes, benefits that you receive. So make the decision with caution. What are other things that people anchor to that don't apply to them?
So a big one of my personal favorites on this list is the inability to shut off the pursuit of more. So if you think about the arc of the typical person, right? You invest, you work, you save, you build, you seek risk. You're looking to grow your balance sheet, right? And you spend 30 or 40 or 50 years doing that. It's a mindset. It's a building wealth, risk-seeking mindset. Think about when you punch out, you're done with work, you're going to retire. It's a content mindset. It's a finding your enough mindset. It's being happy. You can look back and be content with what you've built. And I always say that building wealth and keeping wealth are a very different skill set. It's a very different mindset. Most people cannot or have difficulty turning off the switch from risk-seeking and building wealth mindset to keeping wealth, content mindset. But it's a very important subtle shift in thinking that could be the difference between disaster, seeking risk when the best outcome won't change your life, but the worst outcome will ruin your life, and being happy with what you have. Okay. So the enough mindset is being completely content with what you've built. You're stopping the risk seeking. Like you're no longer in build mode. You're no longer in taking on debt mode or investing in a speculative private business mode. You are enjoying your life. You're taking funds out of your portfolio. You've built a portfolio that reflects the way that you feel about risk. You're sipping on the porch with your spouse or your best friend, and you're sipping on a cocktail with not a care in the world. Sounds small, sounds subtle, sounds easy. I can tell you, after decades of doing this, people don't even know that they need to be making this switch.
Yeah, it's like we've talked about this before. You're just conditioned for more than half of your life to always be in this risk-seeking mode with that mindset. So it is a completely different shift, but it's a whole new set of life, a whole new chapter, and it comes with the territory.
Well, and the best example that I use is, let's say you have a couple $1 million and you've got it invested and you run your financial plan and everything is favorable. So you're assuming your rate of return is zero. You still have plenty of money. You can do everything that you'd want to do. Okay. So that person is financially unbreakable. If that person got a wild hair and said, okay, I'm going to try to take my 2.5 million and turn it into 7 million. Okay. That probably wouldn't drastically change their lifestyle. Okay. But if they took their 2.5 and turned it into 800,000, that would drastically adversely affect their lifestyle. So those are the type of bets where you introduce a risk of ruin and you don't need to. You're set. You should be content. But since you never turned off that risk-seeking mindset, you're putting your whole plan in peril, and it makes no sense. That's a poor trade.
Dropping knowledge bombs. I think that often happens because people overweight. No, that's not right. People normally overweight the downside, right? So that doesn't make sense in this context.
Most of our clients, most clients with wealth were very good at something, and they probably had to compete, and they were always pushing themselves. There was always a pursuit of more, and that's super hard to turn off that competitive spirit, that competitive gene. And I think all it takes is some self-awareness, some turning. I always say, turn the mirror towards you and acknowledge that not everyone can be the richest person alive. At some point, you need to be content and happy with what you've built.
Yeah, I think that, and I think we have a whole podcast episode on this topic, but if you find yourself obsessing over what to do in retirement, where to focus your energy, your finances isn't the place to do it, because you can drive yourself absolutely mad sitting there. What am I going to do next? I have nothing to do. But it's like this doer's tinkering. What do we call it? Tweaking.
Yeah, like
kind of mindset.
Serial tweaker. And where this manifests itself is during good market years, like the last decade has been pretty good. Let's say the S&P is up 10%, and you have a client with a balanced portfolio that's up 7.5%. And that client's going, well, if we would have owned more equities, we could have got 12%. It's like, well, you don't need 12%. You don't need to reach for return or reach for yield. Back to my example, turning your 2.5 into 7 or turning your 2.5 into 800,000. Like, you don't need to introduce that potential outcome into your plan. That's a risk-seeking mindset, and that's what you need to turn off.
Yeah, and it's all about where you focus your energy, which is what I was trying to get out before. Because I have a client that we were talking about, what are you going to do in retirement? You're a natural-born businessman at heart. You've been doing all these new things every single year. You want to always do something different. What does that look like once you are not officially working anymore? And he had all these different business ideas because that's what he enjoys doing. That's what he does for fun. But the point of retirement is to kind of draw that back. You don't have to do this anymore. So we were talking just different activities, passion hobbies, things that he could do in replacement of that to still kind of get that same thrill and enjoyment without putting his personal finances at risk.
That's well said, Erin. I'm sorry to cut you off. I got a little worked up.
That's okay. It's a fun topic.
Okay, why don't you take the trivial decision analysis, paralysis, or whatever you young people say.
Paralysis by analysis. That is decision fatigue 101, where you have so many decisions to make that you just can't make one, or it's like you need to put the blinders on and figure it out. So we see people overanalyzing these decisions that whether you take decision A or B or C, it's really not going to give you much of a difference in the long run. But we often see this manifest itself in Social Security because you have a lot of different options, right? Could be anywhere from 62, 63, 64, 65 up until 70. That's a lot of choices, right? So we try to boil it down to like 3. You either take it as early as possible, take it at your full retirement age, or you take it at 70. But we often see folks overanalyzing just those in-between years. What if I do 67 for 68? And you can get really deep in the weeds in this really quickly. And it's not necessarily a bad thing, but again, it's that paralysis by analysis. You just can't make a decision because there's too many choices.
Yeah. So just to paraphrase, it's a logical discussion to take it as soon as possible, age 67 and age 70. I think those are kind of the 3 main areas. But to agonize over taking it at 69 versus 70, like, that's just not a good use of your time, and it's probably not going to matter if you're running the plan out for 30 years. So don't get deep in the weeds on some of this stuff that's not going to make a sizable difference. It's especially frustrating for a planner like Aaron when someone is agonizing over this decision, yet they're leaking oil in other areas, holding a concentrated position in an investment, or they're spending 2 times what we're modeling in the financial plan. So just pick your battles, okay? And agonizing over 67, 68 on the Social Security side is not one that is going to move the needle a whole lot.
It is good. We don't have really in-depth analysis come across our table for Social Security that often, so it's kind of fun to refresh and do something new. So it's not inherently a bad thing for us, but like you said, if you're obsessing over one thing but leaking oil in another place, you're not focusing on the right thing.
Mm-hmm. Okay, the last one is kind of ties this all together. And if you can't tell from our comments, planning is very much a process, very much a journey. Markets are going to change, your life is going to change, your family's going to change, and the inputs are going to change. So by inputs, meaning your income, your expenses, your taxes, all of that stuff is going to change. So with planning, I think sometimes people fall into the trap of wanting someone to give them all of the answers. Like, give me an 80-page PDF telling me exactly what I have to do, and let's obsess about this plan and make sure it's right. Well, there's several things wrong with that. One, like I just said, life changes. Two, good planning is a process. It's obsessing about the inputs. It's obsessing about the things that you can control. And then the last thing is the further that you go out. So if you're 50 years old and you're going to live until 90, the further you go out, the more meaningless all of this becomes, which is why we always bring it back to the process. So help us understand what you're actually spending versus what we're modeling. Help us set a meaningful return assumption in your investment portfolio. These are all the things that we are going to revisit to make sure that you're still on the journey that we set out.
Yeah, normally I feel like when we look at financial plans, we're looking at the next 3 to 5 years, because a lot can change in that time frame, but it's kind of reasonable to look out that far. Once you start going, 15, 20, 30 years down the line, it's really hard to say what that's going to look like, because 20, 30 years ago, life looked a lot different. So keep that in mind when you are going through your financial plan with your advisor. Stay in the context of where life is at and where it's going in the next couple of years.
Yes. The only thing that we can count on is your plan is not going to go according to plan. So be open-minded, be flexible, focus on the things that you can control. If your advisor is not running the financial plan or not coming up with answers or not modeling various scenarios, feel free to engage us. This is what we do all day, every day for every single one of our clients. It's very much a process. We're not going to give you a notebook to fill out. It's going to be very interactive. It helps us get to know you, and it helps us model the life that you would want to live.
It's a fun process for the client and us, or at least me.
And me, except Aaron heads all this up.
Okay. I think that was a pretty fun discussion. I hope that you got something out of this today. If you have questions, you can reach out to us at insight@pureportfolios.com or at pureportfolios.com. You can find our website. Thanks for listening to this episode of Blind Spots. We will see you in our next one.